China does not have a housing shortage. It has a confidence shortage. At the end of April, 391 million square meters of completed apartments were sitting unsold across the country. Finished buildings, listed for sale, still empty. Enough housing to cover more than 6 Manhattans at the same time. And beyond those completed units lies a second layer of risk. A large number of apartments were sold years ago, but never delivered. Concrete towers frozen mid-construction. Families still paying mortgages for homes they have never stepped into. This is not a normal market downturn. It is a system losing its anchor. For decades, buying a home in China was more than a financial decision. It was security, status, a family plan, the safest place to store savings in an uncertain world. Now that belief is fading. Prices fall, projects stall, trust disappears. How did the largest property market on earth reach a point where homes exist, but buyers hesitate to commit? And what happens when consumer confidence, local government finances, and bank balance sheets are all tied to a belief that is quietly breaking? To understand what comes next, the story must go back to how housing became the backbone of China's growth and why that backbone is now under strain. To understand why the housing crisis in China feels so heavy, it is necessary to understand what housing represents inside the Chinese economic system. Housing was never just a place to live. It became the core financial instrument for households, local governments, and developers at the same time. For Chinese families, property evolved into the primary store of wealth. Capital controls limited overseas investment. Stock markets were volatile and often distrusted. Bank deposits offered low returns. In that environment, apartments became the default savings account. Buying a home was not speculation in the Western sense. It was protection. Parents bought apartments for children. Families pooled savings across generations. A home signaled stability, marriage readiness, and social standing. For local governments, housing played a different role. China's fiscal system left cities with heavy spending responsibilities but limited tax revenue. To fill the gap, land sales became the solution. Local governments acquired land cheaply, rezoned it, and sold long-term land use rights to developers. Those land sales funded infrastructure, public services, and growth targets. In many cities, land revenue quietly became the backbone of local budgets. For developers, housing became a leveraged growth engine. Apartments were sold before construction began. Cash from future buyers financed current projects. New projects funded old debts. Buyers paid for a promise, and that promise financed today's concrete with tomorrow's money. As long as prices rose and sales continued, the system expanded smoothly. Debt was not a warning sign, it was a feature. This created a tightly linked structure. Households trusted developers to deliver. Developers trusted sales to continue. Local governments trusted land demand to fund budgets. Banks trusted property as collateral. Confidence, more than cash, kept the system moving. This model worked for years because demographics, urbanization, and rising incomes moved in the same direction. Millions migrated to cities. Household formation increased. Prices climbed steadily. Housing appeared safe because the system had never been tested under sustained stress. That stress arrived when growth slowed, population trends began to shift, and debt levels became impossible to ignore. Once sales slowed, the feedback loop reversed. Developers lost cash flow, construction stalled, trust weakened, buyers hesitated, local governments lost land revenue, and banks grew cautious. Each reaction reinforced the next. What makes this crisis different from a typical housing downturn is its central role. Housing in China is not a side sector. It sits at the intersection of savings, public finance, credit creation, and social expectations. When housing confidence weakens, the impact does not stay contained within real estate. It spreads. The next step is to examine how policy decisions and debt controls pushed this system past its limits, and why efforts to reduce risk ended up accelerating the collapse of trust. The first crack in China's housing system did not come from falling demand or a sudden recession. It came from policy, specifically from a deliberate decision by Beijing to change the rules of debt after decades of tolerance. For years, property developers in China operated inside an implicit bargain. As long as they delivered growth, jobs, and rising land prices, access to credit would remain available. Balance sheets expanded rapidly. Debt piled on top of debt. Few believed the government would allow a major developer to fail in a way that threatened the system. That belief became embedded in pricing, lending decisions, and household behavior. In the late years of the 2010s, warning signs were already visible. Developer liabilities were swelling faster than revenues. Projects multiplied across smaller cities with weaker demand. Apartments were built not for living, but for storage of value. Policymakers saw the risk clearly. What they underestimated was how dependent the entire system had become on continuous leverage. In the year 2021, Beijing introduced what became known as the Three Red Lines policy. The goal was straightforward: reduce excessive borrowing by forcing developers to meet basic financial thresholds. Limits were placed on debt relative to assets, debt relative to equity, and cash relative to short-term obligations. Developers that failed these tests faced restrictions on new borrowing. On paper, this was a rational move. It aimed to slow speculation, cool prices, and prevent a disorderly collapse later. In practice, it acted like a sudden brake applied to a vehicle moving at full speed. Developers that relied on rolling debt found themselves cut off almost overnight. Refinancing channels narrowed, bond markets shut. Trust between lenders and builders evaporated. Projects that depended on constant inflows of presale cash stalled as buyers sensed trouble and delayed purchases. The system did not gradually adjust. It seized. This shift became visible when even the largest developers began to struggle. The crucial mistake was not the intent of the policy, but its timing and sequencing. The housing system had no shock absorbers. There was no alternative source of demand ready to replace speculative buying. There was no mechanism to guarantee project completion at scale. Once leverage was restricted, cash flow collapsed first. Construction stopped next. Confidence fell last but hardest. This was the moment when a financial correction became a social crisis. Buyers who had prepaid for homes suddenly faced uncertainty. Delivery dates slipped. Construction sites went quiet. In some cases, payments continued while progress stopped entirely. The unwritten contract between households and the housing system broke, and once that trust was damaged, no amount of rate cuts or slogans could restore it quickly. Beijing eventually softened its stance. Restrictions were eased, support measures were introduced, but by then, the damage was done. The message had changed. The government was willing to let large developers struggle. Homes were no longer guaranteed outcomes. Risk had shifted from balance sheets onto families. The policy shock did not cause the housing crisis alone, but it triggered the chain reaction that exposed every weakness beneath the surface. And once leverage stopped growing, a deeper problem emerged. Demand itself was not as strong as the system assumed. When the flow of easy credit slowed, policymakers expected the housing market to cool. What they did not expect was how quickly demand itself would disappear. That disappearance revealed a truth that had been hidden for years. Much of China's housing demand was not organic. It was borrowed from the future. For a long time, rising prices masked this weakness. Apartments were purchased not because families needed more space, but because owning property felt mandatory. It was the safest savings vehicle available. It was a prerequisite for marriage in many cities. It was a way to keep up with inflation and social expectations. Demand looked endless because incentives pushed everyone in the same direction. But demographics were already turning. China's population had only very recently peaked, and household formation was no longer expanding at the pace developers had assumed. Urbanization slowed as smaller cities struggled to attract stable jobs. In many areas, apartments were built far faster than people arrived. Vacancy was not an accident. It was a structural outcome. At the same time, income growth lost momentum. Manufacturing wages flattened. Service sector jobs became less secure. Youth job prospects weakened. Young buyers, once the engine of pre-sales, became cautious. A long mortgage no longer looked like a stepping stone. It looked like a trap. This is where the illusion broke. In a healthy housing market, demand is anchored in use. People buy because they need shelter near work, schools, and family. In China, a large share of demand had shifted toward storage. Apartments were bought and left empty. Lights stayed off. Entire districts existed more on balance sheets than in daily life. As long as prices rose, this did not matter. But once prices stalled, the logic reversed. Why buy something that does not generate income, does not provide utility, and may fall in value? The moment buyers asked that question, transactions froze. This is why prices did not need to collapse violently for the market to fail. Liquidity disappeared first. Listings piled up. Buyers waited. Sellers hesitated to cut deeply. The market entered paralysis. Second-hand homes revealed this fastest. Unlike new developments, they were less protected by price controls or policy guidance. In many cities, the number of homes listed for sale far exceeded actual transactions. Apartments existed everywhere, but deals stopped happening. Developers responded by cutting prices selectively, offering incentives, or delaying launches. But each discount confirmed buyer fears. If prices could fall today, why not tomorrow? Expectations shifted from urgency to patience. Local governments faced the same reality. Land auctions failed, bids disappeared, revenue collapsed. Cities that relied on future land sales suddenly confronted present budget gaps. Infrastructure spending slowed, public sector hiring tightened. The feedback loop widened. The deeper issue was psychological. Housing had stopped being perceived as inevitable wealth. Once that belief cracked, demand could not simply be ordered back into existence. No policy announcement could force people to feel secure about a purchase that defined their financial future. The system had been built on the assumption that tomorrow's buyers would always arrive. When that assumption failed, oversupply stopped being a statistic and became a lived experience. And as demand weakened, another pillar of the system began to strain under pressure: the finances of local governments themselves. As housing demand weakened and developers pulled back, the strain did not stop at construction sites or sales offices. It moved quietly into city halls and local finance bureaus. This was where one of the most fragile pillars of the entire system had been hiding. For years, local governments in China relied on land as their most important financial resource. Under the national fiscal structure, cities were responsible for funding infrastructure, education, healthcare, and social services. Yet their share of stable tax revenue was limited. The solution was land. Local authorities acquired land at low cost, prepared it for development, and sold long-term land use rights to property developers. The proceeds filled budget gaps and financed growth. At its peak, land sales were not a side income. In many cities, they accounted for a large share of fiscal revenue. Roads, subways, industrial parks, and even routine government operations depended on a steady flow of land transactions. As long as developers were buying and prices were rising, the model appeared sustainable. But this system had a fatal weakness. It worked only if housing demand kept expanding. When developers lost access to easy credit and buyers became cautious, land auctions began to fail. Plots went unsold. Bids came in far below expectations. Revenue that local governments had already counted on simply vanished. Budget holes opened almost overnight. The response was not immediate collapse, but quiet strain. Infrastructure projects slowed. Payments to contractors were delayed. Some local financing vehicles struggled to roll over debt. These entities had borrowed heavily against future land revenue. When that future weakened, liabilities remained. This is where the property crisis merged with the debt problem. Local governments collectively carried an estimated $9 trillion in obligations through off-balance sheet financing structures. These debts were manageable only if land values stayed high and transactions continued. Once land prices softened and sales dried up, refinancing risks rose sharply. What had once been a growth engine turned into a burden. The consequences extended beyond finance. When local governments tightened spending, employment was affected. Construction jobs declined. Public sector hiring slowed. Service providers dependent on government contracts felt the pressure. Household income growth weakened further. Feeding back into housing demand, confidence eroded from the top down and the bottom up at the same time. Beijing stepped in with guidance, support measures, and calls for stability. But central authorities faced a dilemma. Aggressive bailouts risked encouraging the same behavior that created the problem. Limited support risked prolonged stagnation. The path chosen leaned toward containment rather than rescue. This choice reshaped expectations. Local governments could no longer assume that land would always save them. Developers could no longer assume cities would absorb inventory. Households could no longer assume that property would protect their wealth. The land dependency trap had snapped shut. By this stage, the housing crisis was no longer confined to real estate. It had entangled public finance, employment, and long-term growth prospects. And beneath all of it lay a deeper shift that no stimulus could easily reverse. Housing had lost its role as a universal answer. The next chapter examines how this loss of faith spread through society itself, transforming a financial correction into a broader social and psychological crisis. By the time policymakers recognized the scale of the housing slowdown, the crisis had already moved beyond balance sheets and budgets. It had entered the social layer. This was the most dangerous phase, because once trust breaks, it cannot be repaired with liquidity alone. The Chinese housing system was built on an implicit social contract. Families agreed to commit decades of savings and future income in exchange for a simple promise: pay today, receive a home tomorrow. That promise had held for a generation. When it failed, the consequences spread far beyond individual projects. In many cities, construction sites went quiet without warning. Cranes stopped moving. Workers disappeared. Buyers continued making mortgage payments while watching progress stall month after month. Delivery timelines became vague. Communication from developers faded. For households, the experience was not just financial stress. It felt like betrayal. This is how mortgage boycotts emerged. For a system that relies heavily on compliance and stability, the refusal to pay mortgages was extraordinary. It was not driven by ideology or protest culture. It was driven by fear. Buyers were paying for something that might never arrive. Stopping payments became a last resort, not a political statement. The damage from this moment was profound. Mortgages are not just contracts between banks and households. They are symbols of trust in the future. When buyers stop paying, even selectively, it signals that the future itself feels unsafe. Banks reacted by tightening lending standards. Developers lost another source of cash flow. Buyers waiting on the sidelines saw confirmation of their fears. The cycle reinforced itself. At the same time, younger generations were recalculating their relationship with housing altogether. For years, home ownership was seen as a rite of passage. It unlocked marriage prospects. It signaled adulthood. It justified long work hours and delayed consumption. Now that logic was breaking down. Young people faced stagnant wages, uncertain employment, and rising living costs. A long mortgage tied to a declining asset no longer looked responsible. It looked reckless. Many delayed buying. Others delayed marriage. Some delayed starting families. The housing slowdown fed directly into demographic stress. The emotional shift mattered as much as the financial one. Housing stopped representing progress. It began to represent risk. Parents who once encouraged children to buy began urging caution. Conversations around dinner tables changed tone. Security gave way to anxiety. This is why stimulus struggled to gain traction. Lower interest rates cannot restore belief. Looser purchase restrictions cannot repair broken expectations. Once people internalize the idea that housing is no longer guaranteed to deliver safety, behavior changes at a deep level. What emerged was not panic selling, but prolonged hesitation. Not a crash, but a freeze. A market suspended between what it was and what it can no longer be. By this point, the crisis had revealed its true nature. It was not just about too much supply or too much debt. It was about a society renegotiating its assumptions about wealth, security, and the future. And that made the problem far harder to solve. The next step is to place China's experience alongside other major housing downturns to understand what makes this crisis unique and why its consequences may unfold more slowly but more deeply. To understand why China's housing crisis feels different, it helps to place it alongside other major property downturns. At first glance, the comparison seems familiar. The United States experienced a housing crash in the late 2000s. Japan lived through a real estate collapse in the early 1990s. Prices fell, debt surged, growth slowed. Yet China's situation diverges in one critical way. Those crises were violent. China's is slow. In the United States, home prices fell sharply, but markets eventually cleared. Banks wrote down losses, households defaulted, construction collapsed, and then slowly rebuilt. The pain was intense but visible. The system broke quickly and then reset. Japan followed a different path. After its asset bubble burst, prices declined gradually over decades. Debt lingered, growth stagnated. Confidence never fully returned. The economy did not crash. It drifted. China appears closer to the second path, but on a far larger scale. Unlike the United States, China has avoided mass foreclosures. Unlike past Western crashes, it has not allowed prices to collapse freely. Administrative controls, state banks, and policy guidance have slowed the adjustment. This has prevented panic. It has also prevented clearing. Homes remain unsold. Developers remain under strain. Buyers remain cautious. The system absorbs losses quietly, spreading them over time. A fast crash makes noise. A slow crisis sounds like silence. The scale matters. China's property sector was often estimated to account for around 1/4 of economic activity when related industries are included: construction materials, appliances, furniture, local services. When housing slows, the shock ripples outward. Few countries have ever tied so much of their growth to one asset class. The consequences extend beyond economics. Consumer confidence weakens when household wealth feels uncertain. Families spend less. Big purchases are delayed. Precautionary savings rise. This suppresses demand across the economy, even in sectors unrelated to housing. Local governments face long-term pressure. Without reliable land revenue, budgets tighten. Infrastructure investment slows. Social services face constraints. Debt burdens grow heavier relative to income. Fiscal flexibility shrinks. Banks operate under a cloud. Even without widespread defaults, exposure to property and local financing vehicles forces caution. Credit becomes selective. Private businesses struggle to borrow. Innovation slows. The political implications are subtle but serious. Housing was a pillar of social stability. It aligned personal ambition with national growth. As that alignment weakens, expectations shift. People become more risk-averse. Mobility slows. Optimism fades. This is why comparisons to sudden Western crashes can mislead. China is not experiencing a sharp collapse. It is experiencing erosion. A slow adjustment can be more damaging than a fast one. It drags on confidence year after year. It discourages long-term planning. It reshapes behavior in ways that are difficult to reverse. In this sense, China's housing crisis is not only about buildings or debt. It is about momentum. An economy built on forward motion is learning what it feels like to stall. The question is not whether China can stabilize its property market. It likely can. The question is whether stabilization is enough to restore belief, or whether the system has entered a prolonged period of caution and lower growth. That brings the story to the final challenge. What can actually be done, and what does the future realistically look like from here? By the time China's housing crisis reached its current stage, the challenge was no longer how to restart rapid growth. It was how to prevent deeper and more lasting damage. Policymakers gradually shifted their focus from expansion to stabilization, from lifting prices to managing expectations. The first priority became delivery. Authorities emphasized completing unfinished projects above all else. Funding channels were open to ensure construction resumed on stalled developments. State-owned entities were encouraged to step in where private developers failed. The logic was direct. A completed building restores more confidence than any policy announcement. Without delivery, no other measure could work. This approach reflected an important admission. Restoring trust in housing requires physical proof, not financial incentives alone. People needed to see keys handed over, lights turned on, and buildings occupied. The second pillar was targeted support for demand. Mortgage rates were lowered. Down payment requirements were reduced. Purchase restrictions were eased in major cities. These steps were designed to help genuine buyers rather than reignite speculative fever. The objective was not another boom, but to slow the decline and prevent further paralysis. Yet the limits of these tools became clear quickly. Lower borrowing costs cannot persuade households to take on long-term debt if income growth feels uncertain and prices are expected to drift lower. Policy can make buying easier. It cannot make buying feel safe. The third adjustment involved local government finance. Efforts were made to stabilize land markets, repurchase idle land, and restructure local financing vehicles. Central authorities provided guidance and selective support while avoiding blanket bailouts. This signaled a shift toward fiscal discipline. Growth would no longer be purchased at any cost. This restraint carries trade-offs. Without stronger revenue sources, local governments face prolonged budget pressure. Investment remains cautious. Public services operate under tighter constraints, but a full rescue could entrench the same dependencies that created the crisis. Looking ahead, three broad paths emerge. In the first, stabilization gradually takes hold. Prices stop falling. Delivery improves. Confidence recovers slowly. Housing loses its role as a growth engine but regains its place as shelter and long-term savings. The economy adjusts to a lower but more sustainable pace. In the second, stagnation sets in. Sales remain weak. Prices drift lower over time. Investment stays subdued. Growth slows structurally. This path resembles Japan's experience. There is no collapse but no clear revival either. In the third, risks intensify. If delivery falters or local debt pressures escalate, trust could erode further. Mortgage stress could spread. Financial institutions might face tighter constraints. In this scenario, the social and economic costs would rise significantly. Which path prevails depends less on stimulus and more on expectations. If households believe the worst is past, behavior will gradually change. If uncertainty persists, caution will dominate. One outcome is already clear: housing will no longer carry the economy. China must rely more on consumption, productivity, and innovation. That means households must feel secure enough to spend, and private firms must feel secure enough to invest. The era of housing as a universal solution has ended. The final step is to draw the lesson from this shift and to understand what it means not just for China, but for any economy that ties prosperity too tightly to property. China's housing crisis did not begin with empty buildings or falling prices. It began with a belief that lasted too long. The belief that homes could absorb unlimited savings, that land would always rise in value, that growth could be rolled forward through debt without consequence. For years, that belief aligned households, developers, banks, and governments in the same direction. It delivered rapid urbanization and visible prosperity, but it also concentrated risk inside a single asset. When that asset stopped feeling safe, the entire structure began to strain. What is unfolding now is not a dramatic collapse. It is a reckoning. Housing is returning to its basic function as shelter, not as a financial shortcut. That transition is painful because it forces society to accept slower growth and fewer guarantees. The lesson reaches far beyond China. Any economy that turns property into its primary store of wealth eventually faces the same question. What happens when prices stop rising? The answer is never limited to real estate. It flows into consumption, public finance, demographics, and social trust. China still has tools. It retains control over banks, land policy, and administrative coordination. It can stabilize the system, but stability is not the same as confidence, and confidence cannot be ordered or announced. It must be rebuilt through delivery, consistency, and credible reform over time. For households, this adjustment is personal. For policymakers, it is structural. For the rest of the world, it is instructive. Understanding how housing became a burden in the world's second-largest economy is not just an academic exercise. It is a warning about incentives, assumptions, and the hidden costs of tying prosperity too tightly to a single engine of growth. If this analysis helped clarify the forces reshaping China's economy, consider subscribing to the channel and sharing the video. Long-form analysis exists to move beyond headlines and explain how systems actually work. The next crisis rarely announces itself. It builds quietly, just like this one did.